Hello and welcome to Moneylife. This is Sucheta Dalal. This week we're going to talk about a very intriguing story which was put out by PTI, which is a news agency. Now, this story did not quote anybody, but it says top official from SEBI had said that SEBI is working on something which is going to be a world beating initiative, a world first, which is it's going to put out market risk factors which are supposed to help you and me as investors, ordinary investors, because SEBI seems to think that it's got so much of information from all over the place built over the last 30 years of its existence that disclosures that are in the public place may not be enough, and the regulator needs to step in with all the data and data sets, as it calls it, and make this available to investors so that they can make good investment decisions. How interesting, isn't it? I mean, it got me thinking about what exactly is SEBI going to put out? What is the regulator going to be able to say within the framework of the law and its duty to act as a market watchdog? Is it going to warn you about wrongdoing? Because that's what the story indicated. This article has been published all over by all newspapers, obviously, because it is from the Press Trust of India. So let me first say what the article says. It quotes an unnamed SEBI senior official saying that it's got huge capabilities which has been created over the decades, including cutting edge technology and data, to analyze things that have gone good or bad for investors and pass it on in the form of risk factor disclosures which will benefit them. It also is quick to clarify that this is a work in progress, early stages of discussion, but the aim is to avoid the herd mentality that has been particularly visible in recent years among investors, obviously. Now, this is anonymous kite flying, which is very normal over my 35 years in business journalism, where the government or a regulator wants to try something unusual. It puts out an anonymous story, which is source-based. If there's a lot of negative reaction, it's just dropped. Personally, I believe this is something like this. But I decided, let me not be judgmental. Let me ask other people in industry, what do you think is SEBI wading into? Because what kind of data can SEBI give out? Everyone I spoke to was clueless, except of course there's one commodity participant association which has been quoted in the media as having wholeheartedly welcomed the move, and that it wants a regulator to go beyond standard statements and talks about the economy, macro tailwinds, etc., and be very specific about disclosures. Seriously? Now, the news report suggests that clearly SEBI is feeling the pressure to do something. Markets are going down. The investor population, as I keep saying in this video blog, has doubled since the pandemic. When people were locked at home with nothing to do, they discovered the Indian stock market, quickly did some Google exercises, trainings or whatever, learnt a little bit and have been investing. In a bull market, everybody is a genius. So there was a frenzy. The market kept going up. Why just markets? Everyone was an expert in derivatives because they picked up some surefire trading. Every day your WhatsApp and Telegram groups had information about how you can't lose money. People were quick to subscribe. Then of course there was a whole cryptocurrencies craze. The Reserve Bank of India kept issuing warnings. People like us did. Typical of these days, you get abused when you say something sensible or warn people against wrongdoing. So nobody listened. This is typical of any ferocious bull market. On the other hand, it's also typical for the regulator, for the finance ministry, for the government to feel pressure to do something. Okay? It's happened throughout. It happened in the 80s when I came into journalism. And obviously, this kite flying suggests that SEBI is under pressure. Imagine this time the sheer noise on social media with 15 million new investors. Investor population double, like I said. So the noise is much more. SEBI is not doing enough. Look at those IPOs. Prices are, half. What's happening to cryptocurrencies? Weren't we warned enough? So SEBI says it's doing something path-breaking. The real source of this panic is obviously the way the index has fallen. The BSE Sensex, going to refer to it, most popular, reached a peak in October 2021. So it's been a slide since almost a year. In fact, India's market is not doing very badly as compared to the rest of the world. This kind of up and down is normal, but investors who came in post pandemic think that markets have to go only up, up, and up. The truth is they zigzag. They go down, they go up again. So the Indian market, since the high of October 2021, is zigzagging downwards. After new lows in March and June, it's gone up a little again. And yesterday it was 54,000, which was 12th July. Right? Now, most new investors don't know this. It's a learning cycle. They get burnt. But like I said, government is under pressure to do something. In the 80s, believe it or not, in one decade, the government set up 4 committees. Those markets were like a broker's club at that time. At their worst, broker defaults happened all the time and investors lost money when their broker defaulted. So just take a look at it. 1986, GS Patel Committee was asked to recommend ways to instill discipline, ethics and professionalism in the capital market. Those interested in history should read it up. Hard-hitting report by a wonderful chairperson. 1987, a committee under Dr. S.A. Dave. I used to report those days, and I remember every time there was a leak about this committee wanting to do something, after the committee, even after things were accepted, the markets just went down and down and down. You cannot micromanage or technically engineer the market to go up or down. So the government set up a third committee, this time headed by Dr. Abid Hussain, who was then a planning commission member. This was to suggest ways to motivate growth of the capital market. That wasn't enough. They realized that, BSE doesn't listen. Now let's set up the Firwani committee. MJ Firwani used to be the chairman of UTI, the original big bull. He looked at how to motivate and revitalize the market, look at capital trading and debentures. The Firwani committee suggested setting up the National Stock Exchange. Each committee got a few suggestions accepted. Nothing really changed. The big change happened post 92 after one bull run led by Harshad Mehta. SEBI got its statutory teeth, became a powerful regulator, not very powerful in the initial days, but powerful enough to call brokers to book, instill discipline, at least flag all the wrongdoing. National Stock Exchange was set up. It decided to set up a nationwide. So don't go by only the bad news. Please read our book, Absolute Power. The NSC did wonderful transformational work. That was a game changer. The biggest game changer, of course, was our foreign currency crisis, which led to a World Bank loan and led to economic liberalization here. It dismantled red tape, allowed Indian corporate sector to grow, allowed foreign institutional investors to come in, and really the markets have never looked back after that. So that is the kind of change that was required. Did it stop scams? Did it stop the market going down? Not at all. You had the security scam, JPC was set up. 10 years later, you had a mirror scam by Ketan Parekh, who was a Harshad Mehta crony. He took advantage of the whole dot-com craze. So when the dot-com bubble went bust in 2000, 2001, the K10 stocks collapsed. India then escaped the third global scandal, which was accounting scandals, which took down people like Enron, WorldCom. We had Enron over here. Then you had the next scandal, 2008, which is a global financial scandal, which certainly rocked Indian capital markets. So point I'm making, short point, is this 4-decade history shows you that markets will go up and down depending on fundamentals, depending on the global situation, and no amount of artificial engineering is going to revive it. And certainly not disclosures. It has been attempted, it hasn't worked, and even the regulator, anonymous ones, should have some sense of history. Not very far, just 40 years is good enough. So you cannot fix things by data and warnings, because in a bull market nobody listens. Regulators can do one thing, which is at best ensure that investors have all the information that they need. They can mandate disclosures, and SEBI has been doing it. Disclosure norms have been tightened over the years, over and over again. There have been warnings even by Reserve Bank of India. Remember the number of warnings about cryptocurrencies, which I said nobody listened to. Then regulators have warned about cyber fraud, online scams, investing in Ponzi schemes, money circulation schemes. Do investors listen? Every day we at Moneylife Foundation have new people crying out for help because they haven't listened, they haven't read, they have gone by someone who says you'll get a very high return, and they're happy to give away their money. Today, thanks to social media, we live at a time when actually discerning investors have very high quality, affordable investment information and research available largely free or at a very low cost. It's about the economy, it's about specific sectors of industry, about individual stocks. Only a tiny bunch of investors look at it or even understand that once you have invested, the price may go down. There's nothing to panic unless you have been speculating wildly. Similarly, there were plenty of warnings about these high priced IPOs. Enough of discerning people told retail investors that most of these startup tech IPOs are looking at you investors as yet another round of silly money which can be burnt easily. Prices have crashed. You are screaming because many of those who came in knowing the facts thought, we are the smart ones, we will buy, it'll go higher, we will flip it. Nobody intended to hold on. Those who didn't, those who don't read, those who got carried away by WhatsApp University, lost money. So now let's come back to the beginning. In the light of all that I've said, what are the risk factors that SEBI can put out? What is this cutting edge data that they can put out? So if SEBI knows that a company has not disclosed something, as its top official says, we don't expect SEBI to put out disclosures. SEBI cannot on its own unilaterally put out disclosures about industry or about a company. It has to ensure that the company discloses. If the company does not do it, we expect the regulator to be a regulator and act, investigate, and take enforcement action, punish them. SEBI can certainly put out insights and analysis on economic fundamentals and risk factors, but like I said, that's general information already being put out by the RBI, Finance Ministry, Niti Aayog. Even the National Stock Exchange puts out a lot of data and information. So what is this cutting edge data going to do which is different? So the only way a regulator can assist investors in making better decisions is by mandating better disclosures, and when it sees any wrongdoing, clamps down on it really fast and hard. In fact, had it done it, lots of things would have been prevented. For instance, one thing that SEBI can do is, first of all, have a better attitude to RTI itself. Second, SEBI can mandate that all 3-4 exchanges that exist submit themselves to the Right to Information Act, because then individual investors ask the right questions. It is the best disinfectant, and this enormous amount of embarrassment over the scandalous goings on at the National Stock Exchange. Believe me, SEBI has reason to be embarrassed. It was caught napping because this monopoly institution was behaving with absolute power, as our book says. It could have prevented a lot of that if NSE was listed and had to make disclosures or was under RTI. SEBI, like I said, has to set its own house in order, not only on RTI, but even its own enforcement actions. Credibility of SEBI orders and settlement processes needs to be drastically improved. Similar issues, equal orders will have wildly different settlement amounts. Don't ask me why. Nobody analyzes. There has to be strict precedence and equivalence, avoidance of contradictory orders. A lot of work has to be done. The regulator has been getting away with it. All kinds of strange warning letters are issued to let off some investors while others are punished badly. We don't know what's going on. I have written about it over and over again. There are a couple of links that I'm putting out up here. You might want to click, go to Moneylife and read them. Finally, Market Watchdog, if you ask me, is more credible when it speaks directly rather than vague bombast from an anonymous top official. Speak to us directly. Be tough. People like it. People want a watchdog to be a watchdog. We are in a good time now. We have a SEBI chairperson with real market experience after a long line of bureaucrats. We here has courage to go off the beaten path. So let's hope that she does something different. No anonymous talking, lot more straight talking. Let's take SEBI back to 1992 and the promise and potential that it held under the chairmanship of a path-breaking chairman like G.V. Ramakrishnan. A lot to be done, can be done. Let's not get carried away with anonymous bombast. If you agree with what I say, spread the word, learn to understand market trends, and subscribe to Moneylife. Thank you.